Hey guys, it is Julie here with JT.Wealth. Today's video, we have our midweek stock market news update. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, it is our midweek stock market news update where we are going to cover a few notable events that have or are going to happen in the stock market this week. In today's video, we are going to be talking about Beyond Meat, Palantir, Cisco, Disney, and DraftKings. Also, just want to take a quick second to say a happy Veterans Day here in the States and happy Remembrance Day up in Canada. A big thank you to all of the veterans who have served in the military. And just before we jump into that, this is just your friendly reminder that if you enjoyed this video, make sure you give it a big thumbs up and check out some of our other videos on the channel as well. Down below in the description, we have some great links for you, including our Patreon page, which gets you access to our Discord chat group, plus some awesome referral links. Right now, Webull is giving away 3 free stocks just for signing up and funding your account, so make sure to check it out. Okay, now first up is Beyond Meat, who had their earnings report on Monday. Now, their stock, which trades under the ticker BYND, is down about 37% since a high of almost $200 on October 9th, and that was after an incredible 55% gain from September. But after their earnings report on Monday, shares of Beyond Meat plunged 22% after the plant-based burger maker reported a large revenue miss and slow sales growth in their third quarter. Their net revenue was $94.4 million versus $132.8 million expected by Wall Street, and a loss per share of 28 cents versus the estimated earnings per share of 5 cents. Analysts at JP Morgan said that it was unclear why Beyond Meat's third quarter results were so weak, and that Beyond Meat didn't really give any meaningful reason behind the decline. And Monday was already a confusing day for Beyond Meat's stock, as it already dropped a bit after McDonald's released that they would be making their own McPlant, which was going to be made by McDonald's for McDonald's. So investors were really confused on what Beyond Meat's role would be in this, if any, and Beyond Meat did then clarify that it would be collaborating with McDonald's in this, so we did see shares recover slightly. So JP Morgan said that the partnership could be very strong over time, but they need more information about whether Beyond Meat will be manufacturing the McPlant, and if the McPlant is a single product or broader platform before they can model McDonald's impact on Beyond Meat's revenue and earnings. In the long run, they believe that Beyond's growth opportunity is impressive, and we see the company as well positioned to keep a large share of the alternate meat pie. But with visibility so low and the most recent quarter surprisingly soft, we think it makes sense to stay underweight on their rating. And if we take a look at the tip ranks on Beyond Meat, it is averaging out as a hold rating with 3 buys, 7 holds, and 5 sells. The average price forecast is coming in at $128, which represents a few percent increase. Second on our list today is Palantir, and these guys have seen quite the rally in the last few days. Now, their stock trades under the ticker PLTR and is up above $15 right now, which represents a 50% increase since the start of November. Palantir has their earnings report tomorrow, Thursday the 12th, after hours, and it will be their first earnings report since they became public on September 30th. These guys are a big data analytics company providing software tools to both large companies and government agencies. The company has been around for 17 years, and those years have often brought controversy, generally tied to its work for the U.S. intelligence agencies. Palantir generates about half of its business from various government agencies and most of the rest from large companies. Now, part of their recent price rally can be attributed to a couple pieces of news we've seen in this last week. And the Financial Times reported that the UK has held discussions with Palantir about using their software to run a test and trace program, although no official deal has been announced. And last month, the Wall Street Journal asserted that the company is working with the US government on a tool to help monitor the manufacturing and distribution of a vaccine once it's ready. As far as their earnings report goes, they projected third quarter revenue of $278 to $280 million, with non-GAAP operating income of $6 to $8 million. For the full year, the company projected revenue of $1.05 to $1.06 billion, with their non-GAAP operating income of $62 to $72 million. But the stock is still relatively cheap compared to other enterprise and cloud plays, and could get a further boost if they top their quarter expectations. Currently, they are rated as a moderate buy with 2 buy and 4 hold ratings. The average price target, though, just comes in at $11.33, which is actually a 26% downside right now, with that highest target being $13. Third on our list today is the American multinational technology conglomerate Cisco. They trade under the ticker CSCO and are currently at $39.06 per share. Now, Cisco is also reporting Thursday after hours, and investors are feeling a little bit cautious. The networking giant's shares have struggled this year, and they're down 18% year to date, amid soft demand from both carriers and small and medium-sized customers. For the July quarter, Cisco reported revenues of $12.2 billion, which was down 9% from a year ago, and the company has projected a similar result this time. More specifically, the company's guidance is for a decline of 9 to 11% in October quarter revenues, or between $11.7 and $12 billion, with their non-GAAP profits of 69 to 71 cents a share. Street analysts are right down the middle of the guidance range at $11.85 billion and 70 cents. And Rivals results could be a warning sign for Cisco earnings, as the reports from Juniper and Arista show that Cisco could struggle to produce solid results in forecast. If we take a look at the stock forecast on tip ranks for Cisco, they are still rated a moderate buy, with 11 buy ratings and 9 holds and 0 sell ratings. Their average price target is at $47.33, which represents a 21% upside. Next up is Walt Disney. Trading under the ticker DIS, their stock is down about 3% since the start of the year, but they did have a 12% jump on Monday after Pfizer revealed promising preliminary results of their vaccine trial. So clearly, investors still feel that the pandemic is looming over some of Disney's potential for success. But they did charge hard into the streaming industry with Disney Plus, which has seen a lot of success in a short amount of time. And investors have been forced to reconsider their thesis on Walt Disney stock in 2020. The pandemic was a near perfect storm for the bulk of the company's entertainment and media businesses, and their earnings did tumble. On the other hand, it's hard to imagine a better accelerant for their new streaming service than a year of stay-at-home mandates and social distancing guidelines. So investors have had to weigh out the greater potential of the long term versus their shaky present. Analysts expect Disney to report a loss of 90 cents per share in the latest quarter, or 73 cents after adjustments. Now that would compare with the $2.61 per share loss in the previous quarter and a 58-cent profit in the year earlier. Wall Street consensus is for $14.1 billion in revenue, which is down 26% year over year, and an adjusted EBITDA loss of $424 million, which compares with a $4.4 billion EBITDA profit a year earlier. Taking a look at Walt Disney's stock forecast, they are still rated a moderate buy with 10 buy ratings and 4 holds. Their average price target coming in at $143.82, representing a 4.5% upside. And last but not least today is DraftKings, who are reporting their earnings before market opens on Friday the 13th. Trading under the ticker DKNG, they're currently sitting around $41.39 per share. Now, this will be their second quarterly earnings release after the company began trading on the NASDAQ on April 24th this year, post completing the previously announced business combination among DraftKings, SB Tech, and Diamond Eagle Acquisition Corp. Now, the Zacks consensus estimate for revenues currently stands at $132.2 million. The mark for their loss has widened from 48 cents to 64 cents per share over the past 30 days. Now, we did just recently talk about DraftKings in another video of ours, as the future outlook for them is looking pretty solid, as there is an increase in legalizing gambling across various states. So the addressable market for this company is going to be growing quite considerably over the next couple of years. And taking a look at their stock forecast, we can see they're rated a moderate buy with 13 buy ratings and 6 hold. Their average price target comes in at $58.06, which actually represents a 39.97% upside. So some pretty exciting earnings reports for some great companies this week, and I'm excited to see how these play out. And I would love to hear your guys' thoughts on these companies, plus what other ones you're watching this week. So leave it down below in the comments. You guys know I always love hearing from you. Keep in mind that these videos are in no way a recommendation to sell or buy any specific stock, and any trading should always be done based on your own due diligence. If you made it all the way to the end of the video, make sure you give us a big thumbs up and that you're subscribed to the channel. Thank you guys so much for watching. I hope you have a wonderful day, and cheers.